The growing interest of the United States in Venezuelan oil cannot be understood through a single event or decision. It is the result of decades of geopolitical strategy, energy security planning, economic competition, and political conflict that has slowly reshaped relations between Washington and Caracas. In recent weeks, that interest intensified dramatically after U.S. forces captured Venezuelan President Nicolas Maduro, a moment that marked a turning point not only for Venezuela but also for global energy markets. Following this development, the United States moved quickly to assert control over Venezuela's oil supply, signaling that oil once again sits at the center of international power struggles. President Donald Trump wasted little time engaging directly with oil industry executives, meeting privately to discuss how Venezuela's once thriving oil sector could be revived, stabilized, and ultimately reintegrated into global markets under a new framework. These conversations highlighted a key reality: Venezuela's oil is not just about energy production. It is about leverage, influence, and long-term strategic positioning in a world where control over resources still shapes global leadership. To understand why Venezuela matters so much, it is important to look at the structure and history of its oil industry. Data from the Energy Institute Statistical Review, referenced by USA Today, offers valuable insight into how Venezuelan oil production rose, collapsed, and became a focal point of international concern. At its peak during the 1990s and early 2000s, Venezuela was one of the world's most productive oil exporters. The country routinely produced millions of barrels of oil per day, supplying energy to global markets and generating massive revenue that sustained its economy. However, by the mid-2010s, that production had sharply declined. By 2015, average daily oil output had fallen to a fraction of its earlier levels. This decline was not sudden, nor was it caused by a single factor. Instead, it was the result of political decisions, economic mismanagement, falling global oil prices, and deteriorating infrastructure. One of the most significant influences on Venezuela's oil industry was President Hugo Chávez, the authoritarian leader who ruled from 2002 until his death in 2013. Although Venezuela's oil industry had already been nationalized decades earlier, Chávez dramatically expanded state control. He believed oil should be used as a political tool to fund social programs, strengthen government power, and resist foreign influence. While these policies were popular among his supporters, they gradually weakened the industry's efficiency and discouraged foreign investment. In 2007, Venezuela was producing around 3.2 million barrels of oil per day, more than 3 times its current output. That year, Chávez pushed aggressively for the government to take larger ownership stakes in private oil projects. Major U.S. energy companies such as ExxonMobil and ConocoPhillips refused to accept these terms and exited the country. Their departure removed technical expertise, capital investment, and operational efficiency from Venezuela's oil sector. Chevron remained, but it operated under increasingly restrictive conditions. However, the loss of foreign partners coincided with another major challenge: the collapse of global oil prices beginning in 2014. Venezuela, heavily dependent on oil exports for government revenue, was hit especially hard. Without sufficient savings or diversified income sources, the state oil company struggled to maintain operations. Equipment deteriorated, skilled workers left the country, and production continued to fall. The situation worsened further in January 2019 when the United States imposed sanctions on Venezuela's oil industry. These sanctions were intended to pressure the Maduro government but had the side effect of accelerating the collapse of production and refining capacity. Oil exports declined sharply, and access to international markets became more limited. Despite these challenges, Venezuela retains one critical advantage that keeps it at the center of U.S. attention: its oil reserves. As of 2024, Venezuela held just under 304 billion barrels of proven oil reserves, the largest in the world. This figure slightly surpasses Saudi Arabia, which held approximately 298 billion barrels during the same period. These numbers alone explain why Venezuela cannot be ignored by any global power concerned with energy security. Venezuelan oil is dense and heavy, requiring specialized refining processes. While this makes it more difficult and expensive to process, it is still extremely valuable, especially to refineries designed specifically to handle heavy crude. Historically, several U.S. refineries were optimized for Venezuelan oil, making the two countries economically interconnected despite political tensions. Venezuela also possesses domestic refining capacity, though it is currently underutilized. Data shows that the country is processing far less crude oil through its refineries than it did during peak production years. If Venezuelan refineries were operating at their intended capacity, the country could have produced more than 1 million additional barrels of oil per day in 2023 alone. However, experts remain skeptical about whether such levels are achievable without massive investment. A report from the Congressional Research Service emphasizes that reaching full refining capacity would require significant maintenance, modernization, and capital infusion. Years of neglect, combined with sanctions and mismanagement, have left facilities in poor condition. Restarting them would not be a simple task. These concerns were echoed by ExxonMobil CEO Darren Woods during a roundtable meeting with President Trump on January 10. Woods pointed out that ExxonMobil's assets in Venezuela had been seized twice in the past, creating deep uncertainty for any future investment. He made it clear that returning to Venezuela under the current legal and commercial framework would be extremely risky. According to Woods, Venezuela's existing legal system makes large-scale investment effectively impossible. For global energy companies to commit billions of dollars, they would need strong guarantees, stable regulations, and protection from asset seizure. Without these assurances, Venezuela remains what Woods described as uninvestable. Still, the sheer scale of Venezuela's oil reserves continues to outweigh these concerns in strategic calculations. From the U.S. perspective, control over Venezuelan oil offers several advantages. It reduces dependence on Middle Eastern oil, limits the influence of rival powers, stabilizes supply chains, and strengthens U.S. leverage in global energy markets. It also prevents adversarial nations from gaining access to one of the largest untapped energy resources on Earth. The capture of Nicolas Maduro represents more than a political shift, it signals the possibility of a complete restructuring of Venezuela's oil industry. For the United States, this moment presents an opportunity to reshape energy alliances, restore production capacity, and redefine Venezuela's role in the global economy. At the same time, the path forward is complex. Rebuilding Venezuela's oil sector will take years, not months. It will require political stability, international cooperation, legal reform, and enormous financial investment. The decisions made now will determine whether Venezuela re-emerges as a global energy powerhouse or remains a symbol of how political ideology and economic mismanagement can cripple even the most resource-rich nations. In the end, U.S. interest in Venezuelan oil is not driven by greed alone, nor by short-term gains. It is driven by long-term strategy, global competition,